Yeah, we remain optimistic on the equity market going forward, really because of some of the reforms that are being talked about by the President and Congress, which are infrastructure spend, less regulation, and lower taxes. So it remains to be seen what type of reforms are ultimately passed and processed, but we remain positive on those themes. And I think there's a number of sectors that could benefit from those. It would be financials with a more pro-growth policy, more economic activity, see loan growth. I think you'll see interest rates rise. There's more inflationary pressures in the market today. I think there's a lot of other sectors that will benefit too. Industrials, obviously, we're talking about bridge repair, road work. So I think there's a lot of improvements there to be made, bringing jobs back overseas, helping the manufacturing base. So I think there's a number of sectors that could benefit from those pro-growth policies. Well, we think if rates are rising for the right reason, that increasing rates is not necessarily a bad thing for equities. So if the economy is growing, pro-growth policies are in place, corporate profits are rising, we're seeing strong cash flow generation and margin improvement, that if that is happening, that rising rates means that the Fed is confident that slightly higher interest rates aren't going to derail that economic activity. So with the Fed raising rates twice in the last couple of months, December here again last week, and then additionally a year ago, last December of 15, we have seen some increasing in rates, and I think it's likely that we'll continue to see rates. But again, if they're happening for the right reasons, meaning economic activity is increasing and the profile of businesses is improving, the market can still perform well. Yeah, so our energy weighting today, including fixed income and equities, is about 15% of the portfolio. And most of our weighting, certainly on the equity side, is within those larger integrated oil companies. That'd be BP, Royal Dutch Shell, Total, Chevron, those types of names. And we're positive on energy really because we feel like the supply-demand equation is moving in the right direction. So oil is a commodity, that supply-demand is critical. So what we mean by that is production cuts have happened, CapEx has come down significantly. A lot of these companies went through a real growing CapEx cycle a few years ago, looking for new projects and exploration. So we feel like CapEx is coming down. At the same time, you're seeing a modestly increase in demand. So you're seeing basically oil growing about 1 million barrels a day in terms of demand. So positive demand, declining production. We think that supply demand is positive for energy, and that will help both our fixed income and our equity holdings. Yeah, so we have a positive view of our healthcare holdings. We very much look at our portfolio is driven by individual security selection. So within healthcare, our exposures in pharmaceuticals and in hospitals primarily. We have some other medical device names as well, but within pharmaceuticals, we remain positive on a number of names like Merck, Pfizer, companies that we think have very compelling pipelines where they're pursuing innovation across a number of platforms. A lot of what's going on in the pharmaceuticals today is around oncology, and we think we're focused on companies that have impressive pipelines or getting drugs through those clinical stages, which is quite positive. So we'll see what happens with the Affordable Care Act, which is under review in Congress today, and we'll see what kind of a repeal, replace bill is ultimately passed or not passed. But our investments in healthcare are based on specific factors really for those companies. So we're not we're investing in names because of the Affordable Care Act or because of repeal, replace measures. There are really multiple reasons why we own each of the holdings we have. And we're optimistic in the outlook for many of our pharmaceutical and hospital holdings. Yeah, technology has been a great source of new ideas for us the last couple of years. So if you think about historical weighting of the fund had a very low presence in technology, and that was because the dividend opportunities in technology stocks was just not there. But with Apple and Cisco Systems and Intel, Texas Instruments, those types of names, Microsoft, a large holding of ours, there's a lot more dividend opportunities in technology today than there were several years ago. So we like that element. In the financial profile of technology companies we believe is very compelling. Strong margin profiles, generating a lot of cash, and now they're allocating a lot of that cash to dividend-paying stocks, dividends. So we think it's really quite positive for technology, and we like the broader exposure that technology gives us. So a lot of companies in technology, whether it be mobile devices or companies that are helping energy exploration or other areas of the economy. So technology gives us, broadens our investment base. We have a lot more sectors to choose from, and we like being a part of those dynamic companies.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。